Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Hello and welcome. We'll be walking through a document titled U.S. Market Peripheral Notes, dated Tuesday, April 14th, 2026.
Now, just a quick reminder before we get started. This presentation provides a direct informational narration of the source document. It's purely for informational purposes and doesn't constitute any kind of investment advice. And of course, investing always involves significant risk. Okay, so here's our roadmap for today. We're going to start with the big picture, looking at a key turning point in the geopolitical and macro landscape. Then we'll dive into how some fresh inflation data is cooling down the narrative. After that, we'll track global liquidity and risk appetite, do a technical checkup on the indexes, examine the divergence we're seeing in financial earnings, and wrap up with the really big theme right now: AI infrastructure and sentiment. So let's jump right into our first section. We're looking at a major shift in the geopolitical and macroeconomic environment. The key takeaway here is that we're seeing a move away from an extreme risk-off stance, and that means the premium investors were demanding to take on risk is starting to shrink. So what's driving this change? Well, a couple of things. First, there's an expectation of US-Iran talks within about 45 days. And the market is largely interpreting the recent blockade as more of a negotiation tactic than a prelude to something worse. On top of that, there's a growing feeling of a grand peace developing, with a consensus around Israel and Lebanon suggesting the regional conflict might be in its endgame. You can actually see this priced into the crude oil market. There's what's called a pronounced backwardation, which, it sounds complicated, but it just means that while oil is tight right now, the market is betting on supply getting back to normal down the road. All of this together means that the fear premium is unwinding, and it's completely reversing the old logic of fleeing from risk assets to safe havens. And that easing of tension flows perfectly into our next topic, the inflation narrative. The latest producer price index numbers are really challenging that bearish argument that higher costs were going to push inflation back up again. Let's just look at the hard data. The year-over-year PPI came in at 4.0%. The consensus was looking for 4.6%, so that's materially below. Month-over-month was even more dramatic, 0.5% versus an expected 1.2%. And if you look at the core numbers, which strip out food and energy, the month-over-month figure was an exceptionally benign 0.1%. The bottom line here is clear. Producer inflation is showing continued moderation. And let's just highlight that 4.0% figure. While it is the highest we've seen since February of 2023, the really crucial part of the story is that it came in well below what everyone was bracing for. That signals a much more controlled inflation slope. And the big banks took notice immediately. Goldman Sachs revised its aggressive inflation forecast downward, stating pretty clearly that this is not a replay of the 2022 inflation cycle. They're still holding to their expectation of 2 rate cuts this year. Over at Deutsche Bank, they noted that the demand for safe havens is fading, and even pointed to the return of the U.S. producer premium, recommending a watch for opportunities under a potentially weaker dollar. This brings us to a really fascinating dynamic: the connection between global liquidity, risk appetite, and what's being called the crypto equity resonance. The impulse right now seems to be buy assets, not cash, and that capital is flowing into high beta assets. And look no further than Bitcoin for proof. It's been showing incredible relative strength, approaching $75,000 and gaining 13% since late February. In fact, it's outperforming both the S&P 500 and gold, which really cements its role as the leading global risk asset. We're seeing this in the options market too. The cost of put options is dropping, which just means there's less demand for downside protection. It all creates this powerful feedback loop. Strength in crypto seems to be creating a positive wave for U.S. equity risk appetite. Now, with all this positive momentum, you might be thinking it's just a straight shot up from here. But our next section takes a look at the technicals, and there's a structural risk of a pullback that's tied to the VIX settlement this week. Technically speaking, things are looking a little overextended. The Nasdaq is on a 10-session winning streak, which is fantastic, but some indicators are flashing caution. The DeMark sequential, for instance, just triggered a 9 reversal signal. Positioning is also stretched. The daily candle has pierced the upper Bollinger Band, and the RSI is deep into extremely overbought territory. So we've got some key levels to watch. Upside resistance is right at 7,000, and we have some downside support from the 5-day moving average around 6,850. So what could actually cause this pullback? It's a mechanical process tied to gamma hedging. Here's how it works. First, the index rallies violently, like it has. In response, market makers have to hold huge long positions in S&P futures just to keep their books delta neutral. Now, the VIX settlement is happening this week. When that completes, those passive long positions held by the market makers get unwound, and the result of that unwinding, it could trigger some structural selling pressure. So the big question on everyone's mind is this a bearish trend reversal? And the answer, according to this analysis, is no. The expected pullback should really be viewed as just a tempo correction. A possible intraday dip of about 0.8 to 1.2% wouldn't be a sign of a top, but rather it would represent a strategic point to add to positions. All right, speaking of fundamentals, let's move on to our fifth section, the financials earnings season. What's becoming really clear is a divergence, and it all seems to be driven by how sensitive different balance sheets are. This table lays it out pretty well. You have Citi, with revenue up 14.1% and net income soaring 42.3%, showing really strong business recovery. Then you have Wells Fargo, where revenue was up 6%, but their net interest income came in below expectations, suggesting they have some constraints. JP Morgan was, well, JP Morgan, strategically conservative with strong underlying performance, revenue up 10%. But the one to really watch is BlackRock. Revenue up 27%, net income up 17%. It's seen as a bullish benchmark, and a breakout in its stock could establish a new uptrend for the whole sector. And that brings us to our final section, which is arguably the most dominant theme in the market today, AI. The story is evolving quickly, moving from what was a compute race to what is now essentially an energy arms race. Yes, the entire AI trade is shifting away from just chip compute and squarely toward energy infrastructure. The new core bottleneck for building out AI data centers isn't chips anymore, it's power supply. A key example of this is the 2.8 gigawatt agreement between Bloom Energy and Oracle to secure power for OpenAI and xAI clusters. Bloom's major advantage is that its on-site fuel cells can bypass the public grid entirely, which offers incredible deployment efficiency. It's no exaggeration to say that AI power has become the market's strongest structural theme. And there are a couple of sentiment amplifiers pouring fuel on this fire. On the one hand, you have developments in quantum computing, like NVIDIA's open-source Ising AI model, which is acting as a technology ignition point in this risk-on environment. And on the other, you have the return of the retail investor. The sharp rally in Robinhood stock reflects that rising participation and really serves as a great gauge for market FOMO. So, let's bring this all together. The note concludes with this quote. The current market advance is being driven by feeding geopolitical premia and the PPI-driven invalidation of the inflation bear case. Any roughly 1% volatility-driven retest should be treated as a fundamentally supported entry opportunity. Basically, the fundamental picture is strong, and any dip driven by short-term volatility should be seen as a chance to buy. And now for the formal notice. This document is for informational and research purposes only, and is not investment, financial, or trading advice. The author is not a registered advisor. Investing involves substantial risk, including the possible loss of principal. All market views are for educational purposes and are not guarantees of future performance. Readers are responsible for their own independent research and decisions.